This is Bill Hornbarger, Chief Investment Officer with Benjamin F. Edwards, with three things to watch for the week of August 7th, 2023. Well, on the economic front, inflation is going to be front and center. The markets will get consumer prices, CPI, and producer prices, PPI, on Thursday and Friday, respectively. Month over month, overall CPI is expected to gain 0.2%, and that would put the year-over-year change at 3.3%. So that would be an acceleration from the previous month, which came in at 3%. Core inflation is expected to be up 4.8%. That's well above the Fed's comfort zone, well above their target. Core inflation heavily influenced by services. And if we look at the overall inflation data, rising energy prices, oil and gas prices in the month of July certainly are going to have a negative impact on prices, and the risk is that those will continue to spill over into the August, September months. Again, the Fed's been very clear that they don't think their work is done in terms of fighting inflation and raising rates. We're almost through the second quarter earnings season. We've had about 80% of the S&P 500 companies have reported earnings. We still have a couple of high-profile releases this week. Walt Disney, Alibaba, United Parcel Services. According to Seeking Alpha, of the companies that have reported, 80% have had positive surprises on earnings numbers, but only 59% have had positive surprises in terms of revenue. And that's the lowest in terms of revenue beats in the last 3 years, so something to keep an eye on. And then finally, we're going to watch the bond market. Bond yields in the second half of July, first part of August, have started to move higher at the longer end of the yield curve. The 10-year Treasury got all the way up to 4.19% last week. That's just below the cycle high of 4.24 that we saw last October. This week, we do get new supply, the quarterly refunding, 3-year notes, 10-year notes, 30-year bonds, and the size of the refundings are actually growing because of the very large budget deficits we've been running. So that's going to be something to keep an eye on, the market's appetite for that increased supply of treasuries.